Welcome to episode 39 of the Tax Talk podcast. As usual, your host, Jared Pilon here, ready to take you through the next episode and the first one post 2024 tax season. So, what have we been hearing a lot lately? Capital gains inclusion rate proposed to go up. So, based on the budget 2024, as announced by the Liberal government on April 16th of 24, they are hoping to push the capital gains inclusion rate up from 50% to 66.67, or for easier terms, 2/3. So what exactly does that mean, going forward? Who does it apply to? What are some things that you should be taking into consideration when you are maybe planning for this potential increase? And what are the actual steps that we should be taking as Canadians when government proposes further tax hikes on us? So first off, what does this potential increase in the inclusion rate mean to you? So if you are an individual recognizing gains up to $250,000 in a single tax year, the proposed legislation would not impact you. Your capital gain would still be subject to that 50% inclusion rate, and the various exemptions as far as qualified shares, farm property, etc., would still apply against that 50% inclusion rate. Now, if you're an individual and your capital gains are in excess of that, then the inclusion rate on anything in excess of $250K would then be included in income at that 2/3 rate. So a potential, down the road, if you're selling, some sort of real estate holding or an investment account, things of that nature, to have a significant boost in the inclusion rate and therefore, the corresponding tax that you would have to pay associated with that. The other side of this is in respect to trusts and incorporated businesses. So for those particular entities, this proposed rate increase would apply on every dollar of capital gains realized by the trust or the incorporated business. So that first dollar of capital gains subject immediately to that 2/3 inclusion rate. So this is going to result in a significant bump in taxes to corporations or trusts. So that's just something to kind of keep in mind as to how this would kind of play out, depending on an individual versus another entity. So a lot of people have been coming into the office saying, should I be taking action now? This is proposed to take effect June 25th and 24 if it passes. Now, one of the big things that have kind of come out in the last day or two here towards the end of April is originally that this measure was supposed to be included within the legislation for budget 2024, but the Liberal government has decided to carve this portion out, presumably by forcing all of the other parties to vote on this legislation separately. They are then able to kind of corner certain parties into maybe being supporters of the ultra-rich if they vote against this bill when it is simply carved out from all the rest of the budget measures. So something to kind of watch for as we kind of progress here. I know the budget has been tabled and not exactly sure the timing of this particular motion and bill to come, but I would expect it to not be too far in behind the budget as well. So, in taking into consideration the proposed date of June 25th, what are some of the things that you need to kind of be aware of? So, as we've kind of talked on the podcast before, there have been a number of changes in 2023 impacting 2024 returns with respect to the alternative minimum tax. So in recent years, maybe you would not be subject to the alternative minimum tax regime when you had a large income inclusion from a tax favorable transaction, such as a capital gains disposal. And then in 2024, with those rules being slightly tweaked, now you might be subject to the AMT regime. So you need to kind of bear in mind, if you're planning to, trigger this capital gain within the next, month and a half here, that you might be subject to AMT, and you just need to plan for that accordingly. Number two, also some rule changes that came into effect for 23 are in respect to the house flipping rules. So say, for instance, you have a residential property or a right on a pre-construction home. You've held that particular property or right for less than a year, and you want to go ahead and trigger the disposal of this. You're not only going to put yourself offside of some other rules, you're going to throw yourself into these deemed house flipping rules, and you're not going to have to worry about that 66 or 2/3 inclusion rate. You're going to be hit with the 100% business inclusion on the disposal of that residential property if you've held that for less than a year. So you need to ensure that you're watching that and not making this disposal decision in a hasty manner. Up next, just in regards to another proposed change within the budget, is just the bump in the lifetime capital gains exemption on qualified small business shares and on qualified farm and fishing property. So bumping the current rate that is been creeping up over $1 million with indexation over the last number of years, and bumping that up to 1.25 million. So something to kind of consider if the property that you are looking to dispose of falls within one of those two categories, the qualified shares or the qualified farm and fishing property. And then lastly, a big one to kind of consider when you're dealing any of this type of planning, whether it's in respect to this change in the capital gains inclusion rate or any tax planning in general, and that's just in regards to what they call GAR, so the General Anti-Avoidance Rules. So what those are essentially looking at is, if you as a taxpayer put together a transaction or a series of transactions essentially with the sole intent of gaining a tax benefit from it, there's no logical underlying, legal or real estate purpose to it. There's no estate planning purpose to it. It is solely, put into action and executed as a means of avoiding or eliminating tax with respect to your particular situation. These GAR rules can apply to that particular transaction and result in significant penalties to you as a result of the application. Now, the rules themselves are kind of going through some amendments as well. As you might have guessed, the government's looking to kind of broaden the implication of these rules to thereby catch more of these tax-associated transactions under these rules, to ensure that any of this stuff is being caught and taxpayers are being hit with penalties associated with them. So not a whole lot of great solutions in regards to this. We're just looking at more tax. And from the way I see it, Canada is struggling with, productivity issues. We are struggling with deficit and debt issues. We are struggling with inflation issues. We are struggling with, getting to the point where we're stagnating and having some stagflation. And we need to take this into consideration. $250,000 in 2024 really isn't a whole lot. If you've held on to a family cottage for, the past decade, guaranteed you're going to have capital gains in excess of $250,000 on that piece of property. You know, if you're a business owner that's worked his or her entire life to save some funds away, you know, you're probably going to have some issues in that respect as well. So for the Liberal government to peg this as a tax on the quote-unquote ultra rich, I think is kind of selling it a bit short, kind of like their implication and the implementation of the UHT and those trust reporting rules. They throw a very broad net, and I think this is going to impact a significant number of taxpayers that, you know, haven't been considered early on with this. What does this end up doing? You know, we keep putting more and more tax on the backs of individuals, you know, namely small business owners who get up every day, you know, they risk their capital, they risk their time to put together, you know, a business that can generate employment, that generates, you know, products and services for the economy that are needed by everybody. And when we continue to put more and more taxation onto small business owners, it becomes harder and harder for them to operate, and you see less and less business starts and less growth from them because you're just saddling them with too much of a burden. So what do we need to do? Much like what we did in respect to the UHT and how those tax laws were implemented on too far of a basis, you know, we need to push back against our members of parliament. They are the ones that are voting on this legislation. They are the ones that are bringing in this, you know, increases to taxation on us. And we need to let them know that this is not acceptable, that we need to lower taxes, we need to reduce the bureaucracy, and we need to get government out of the way. That's how we spur innovation, that's how we spur investment, that's how we get houses built, that's how we fix a lot of the crises that we are currently facing. More government spending, more bureaucracy, more red tape is not going to fix all of the problems that those particular things have given to us at this point in time. So if you hop on to legacyllp.ca, you can find a blog associated with this particular podcast. I've got a draft letter there that you can copy and paste, send to your member of parliament. If at all possible, I would encourage you to put a little additional, you know, blib in there that kind of lets that member of parliament know how this tax is going to impact you personally. When you're sending, you know, form letters to MPs, that's one thing. If you're able to provide a specific, you know, story or an example as to why it is going to impact you personally, that always carries a lot more weight with your member of parliament. So we've got some time prior to, you know, this piece of legislation getting put before the House and being voted on. So I would encourage you, grab a copy of that letter off the website and make some minor revisions to it to customize it for yourself, and then send it off to your member of parliament. I'll put some links there for some within, you know, the central Alberta area, and then just a general website link to grab anybody email address from any MP that might be applicable to you. And I think this is important. We need to stand up and we need to speak for ourselves, for the small business owners in our community, to ensure that we have a system of taxation that is promoting innovation and not stifling business owners, because we rely on them in this country. You know, significant numbers of employees are employed via small business owners, and we cannot continue to punish them for being innovative and spurring our economy on. So that is it for episode 39 of the Tax Talk podcast. Once again, Jared Plon here, as always, as your host on behalf of Legacy Accounting. Hope you have enjoyed this one. It's been beneficial to you. feel free to hop on that website, send that letter off to your MP. Take care, and we will talk soon.